I've watched other industries during previous recessions, and like with most cyclical industries, and I'm not saying Dave is super cyclical. I think it only has a mild amount of cyclicality to it probably. But with other cyclical industries, when things are really good and the stock price is really high, the valuations look really low, and it looks like the right time to buy. And then when the commodity or whatever that they're based off of crashes, everything looks really bad and valuations look unattractive. And it looks like the worst time to buy, but the opposite is true. When everything looks fantastic is when you should be selling. And when everything looks like they're about to die is when you should be buying. But if you only look at valuations and you only look at the present and you don't look at the long-term view with cyclicals, many people will buy at the top and get pissed off on the way down and get upset because they don't realize it looked good because it's a cyclical and you bought it at the peak because that's when it looks the best.
There's actually one bear case because I have actually 2 points. So for the Federal Reserve Bank of Chicago, they had a study from looking at what happened to payday lenders, because this model didn't exist back then, it's even to the same extent. They actually saw increase in business activity. Their businesses grew, they expanded during 2008. During 2020, they didn't. Why?
Maybe because the 2008 was an organic crash and 2020 was more of an artificial sudden thing. Like subsidies. Oh, okay.
Subsidies.
Okay.
That's why.
Yeah.
So they didn't contract. They just didn't expand. So it's funny to say, that's actually one of the risks you could think of, is if there's like some sort of, it's not really a risk though, because it's basically you're taking away their opportunity to expand massively, is all. Again, the Dave's current expansion is take market share away from traditional payday lenders. That's their current one, right? They can swallow up that whole market. Let's say they swallow up the entire market for that, hypothetically. Now they're going to move with the ebbs and flows of that market. And so what affects that market? So according to the data, it suggests that if you have a recession and then the government steps in and does crazy amounts of subsidy, starts cutting people checks, they won't expand into that, because they're not going to get this massive flight of customers that are going to come in and say, well, I need this kind of loan for now. And in something like 2008 happens, where it's a recession that you don't have this like massive, writing of checks, a normal recession, right? A one where we don't go crazy. Well, we don't go as crazy in some respect. Then in that, they have a temporary boost that they could have by getting all these. But again, there's the churn rate. Not everyone's going to be in a perma recession forever. They're going to come in, they're going to have their hardship, but most people are going to go out of it and they're going to recover. So that's something I wanted to talk about. Is in 2016, there's a study from 2016 about the 2008 recession and payday lenders. But
Blake, are there any other? We're doing a bit of a Dave pitch do here. Any other like concerns or questions?
So eventually, maybe this is actually something where like it would be better if I were to go on Capital Mindset's channel and have him and Andrew sit me down and explain to me how to truly read between the lines on the financial statements of money lenders, because I'm used to manufacturers and retailers and service providers, and the way everything is structured, I can read between the lines on those. I can see what efficiency is. I can measure competitiveness. With a bank, I have no clue how to read that, and that is a big part of why I've been avoiding money lenders for forever. Is because I can't read between the lines on their financial statements, and I doubt Fiscal or Ryan can, and I'm pretty sure Capital Mindset can, and I'm pretty sure Andrew can. And I just don't have enough of an accounting background or finance background. I took 2 years of accounting classes and economics classes. I took like 1 class of finance. I did not take enough to understand money lending as well as I know I need to be a certain level of competency to ever invest in a company like Dave. So my threshold for any company in any industry.
I don't really think of them as like a bank, though.
Yeah. So my threshold for investing in any company in any industry is I won't buy any unless I could contribute during a board meeting, right? I need to understand the company well enough to be a part of the conversation. I don't have to be the hotshot genius in the room, but I just have to be able to contribute. And with the money lenders, I just don't feel like I've ever had anything special to say or understood them well enough that I would be able to contribute. So I've never fallen above the threshold where I felt I was competent enough to invest in a money lender. Even though I know Dave is very simple, I finally understand it. I finally found a money lender that is simple enough to just be like, it really just does one thing and does it pretty well.
Yeah. Because I will say, like, I feel the same way about like traditional banks. Like, it's like, wow, sometimes there's things that are so hidden between the lines that you don't even know you should be looking for it. Mm-hmm. And unless you're an expert on banks, it can turn against you very quickly. And I'm not super comfortable like that. That's why you don't see me buying like Bank of America or JP Morgan. I mean, at one point in time, I might have had a couple of bank stocks, but the reason I'm out of them and not involved is because I realize this play with fire, and sometimes you get burned, especially if you don't understand that it's hot.
I've been more tempted for like Visa and MasterCard than to get into like a normal bank or money lender.
I actually, I would. I mean, I think that even though it's not the exact same thing, it's more in the same realm of like they're kind of like they're just taking a little piece of each transaction in a way, except they are forwarding, they're advancing you the $500 or whatever, but they're just taking a flat piece of each 500 and turning it around, compounding it every 8 days or so.